Hello, learners. I trust you are all well. So, welcome to our revision series. In today's class, I want us to handle, of course, advanced management accounting. And the concept that I want us to handle today is a concept to do with the value of information. Value of information. Remember, these are one important concept, of course, in our syllabus for advanced management accounting. So anytime we are to talk of the value of information, what will it entail? You'll find that many a times, of course, will always be required to make decision as management. And to make this decision, of course, I'll have to do my research. There's that aspect of what you normally term them as R&D, research and development cost, right? So we'll have to do this research so that at any given point I'm making my decision, a decision should always be very efficient and effective. So for me to make this decision, I'll need information. This information is going to be gathered in the market, and I won't gather this information for free. I'll have to pay for this information. So the whole idea that we'll be looking at under the value of information is that we will be required to compare the value that this information is bringing in the firm and the cost that I'm going to incur. So the whole idea will it be viable for me to pay for this information, or will it not be viable? So this is a concept that we'll be looking at majorly under this case. And many a times you'll find that when you are looking at the value of information, of course, you won't get 100% accurate information. Yeah, there's no information that is always perfect. You can't get 100%, of course, accurate information. So that's why this will take us to the concept of us determining the value of perfect information. Yeah, however good the information is, I must determine its value. So looking at the value of perfect information. Value of perfect information. How will you be required to determine the value of perfect information? To determine the value of perfect information, all that will be required to have is to consider the expected value. These are expected value of, that is the expected value of information without perfect, expected value without perfect information. That is a expected value without perfect information. You read about expected value with perfect information, with less expected value without perfect information. So this will give us the value of perfect information. And many a times when you are talking about the expected value without perfect information, remember the concept that we did of expected monetary value, right? So all we'll be taking here, we'll be taking the best expected monetary value in our decision alternatives. In our decision alternatives. See? So from the decision alternatives that I'll be having, I'm going to take the best expected monetary value. Molimo had guided us about the expected monetary value. Then for us to determine the expected value with perfect information, all that we will be required to do, my good students, it is to consider you take the maximum payoff under each state of nature. You take the maximum payoff under each state of nature. In this case, we determine what? Under each state of nature, then determine the average, determine the expected return. So when you are talking about the aspect of expected value with perfect information, Molimu is clearly saying here that allow to check in our state of nature. From our state of nature, we'll have to determine the maximum payoff under each state of nature. That is the best payoff under this state of nature, because the state of nature we can't predict, but decision alternative we can always decide what to take. So after we have determined the maximum payoff under each state of nature, then we determine what the expected return. The expected return is simply to multiply the same by the probability. So once you have this, you'll find that you are going to determine the value of perfect information. So many a times you'll always be required to compare with the cost of information. Many a times you'll always be required to compare with the cost of information. So whatever that you're determining here, if at all you're to measure it in a quantitative manner, that is the value that this information is going to bring to the firm. You compare with the cost that you're going to or you'll be anticipated to spend in acquiring that information. So at that point, it will be upon you to determine if that is viable or not viable. So this should take us to a question which I want us to handle. This question was tested in April 2024. This question was tested in April 2024. And I'm sharing with us here. April 2024 should be question number 3B. Should be question number 3B. This is a question which I've shared with us on the screen, and I believe it is very visible. Believe it is very visible. Yeah. So if at all we were to go through this question, what were we given? We go through this. First of all, we highlight it all. We are told that Solar Max Limited makes small assembled solar panels for the domestic local market. The marketing manager believes that in the short run, their sales can improve by launching a massive marketing campaign strategy. So the following marketing strategies have been proposed based on the demand for the product. So all we are having here, these are the strategies, decision alternatives, right? Advertising locally, online marketing, mass media advertisement with the local television media house. We're told the company uses expected value to make this type of decision. The estimated annual profit or loss under the three states of market reaction for each market strategy is as follows. So I'm given our market reaction and our strategies. Then additional information, we are told. Strategy A has low fixed cost and high variable cost. Strategy B has average fixed cost and average variable cost, while strategy C has high fixed cost and low variable cost. Number two, there is a 30% chance that demand will be high at 40%. That is 30%. Will be high. A 40% chance that demand will be medium, and a 30% chance that demand will be low. See, so whatever that a good examiner has given us here, we're given the probability of our state of nature because it is based on the past experience. We know or we can likely predict what might happen, and that's why you're having what probabilities. Number three, market research company believes it can provide perfect information at a cost of 100,000. So this researcher who believes that he can give us this information, perfect information, at how much? 100,000. We are required to calculate the maximum amount payable to acquire perfect information. And also we are supposed to advise management of Solar Max Limited whether it is viable to acquire the perfect information from the market research company. So that is very important to note. And these are what you're going to do. We have our payoff with us here, which we are given all the details regarding our product. So in this case, the beauty part is that once you have your payoff, all these other elements will always tend to be very, very easy. Important is for you to consider or for you to master your payoff. That is very, very important. That is very, very important for you to always note. So then this is what we need to consider here. You'll be having, of course, that with you. Let me erase this point so that you can use this space. But you'll find that these concepts are always as easy as that. No complications, so long as you are able to understand the main concepts, or talk about the key areas, right? So we have our payoff. So Mwalimu is going to prepare the payoff as per what you are given by our good examiner here. Then we should be able to work it out. So based on our payoff, I'm given our marketing strategy. So these are our decision alternative. Marketing strategy, we're having market locally. We're having online marketing. We are having mass media advertisement. So these are what you're given. Probability, what were we told in relation to probability? We are told that probability, it is going to be based on the state of nature. And the state of nature, as per what our good examiner here had given us, we're having the state of nature, which is high, H, medium, and low. Probability of high, you can clearly see we are given what? There's a 30% according to note 2, 30% chance that demand will be high. So I'm having 0.3. 40% chance that demand would be medium, 0.4. And 30% chance that demand would be low, 0.3. See, we're having our probabilities there. In terms of returns, I was given the first case, market locally, 1.3, 1.5, and 1.7. Medium, I was given 500, 850. I'm just copy pasting fast what you're given, 905. And finally, at low, we have 350 for 10, negative 105. Our figures, we were given that our figures were in thousands. So once I have that, I can literally remove this question. These figures of ours were in thousands, right? Our figures here were in thousands. See? So we are asked to advise or to determine the maximum amount that I can pay to acquire this information. So what the good examiner is asking you here is for you to determine the value of PI. Value of perfect information. So to determine this value of perfect information, we should understand clearly that I'll be talking of the expected value with perfect information, less the expected value without perfect information. That is what you need to understand, and Mwalimu had explained that. So we start with expected value without perfect information. So to determine the expected value without perfect information, we need to determine the EMV, expected monetary value, under each state of nature. So max locally, what will I be having as our EMV? Because here you need to take the best EMV. We need to take the best EMV. So if at all you're to market locally, what will we be having here? That will be very simple because I'm going to consider our value of this state of nature. So I'll be having 1.3, my good students. We multiply by the probability of that, which is 0.3. We are going to add 500 by 0.4. Then finally we add 350 by 0.3. This will give us our EMV at that state of nature. The other item for online marketing, the same procedure will apply, where I'll be talking of the 1.5 times 0.3. We add, that is 850 times 0.4. We add 410 by 0.3. See? All we need to determine first of all is what? The expected value. The expected value. After that, we also consider mass media advertisement. So for mass media, I'll be talking of 1.7 by 0.3. We add 905 by 0.4. We add negative 105 by 0.3. So these are what we should be having. So therefore, my EMV on the best or on the first strategy, I'll be having 1.3 times 0.3. We add 500 by 0.4. We add 350 by 0.3. In our case, you can see I'm getting 695, believing that it is the same value that you're getting. 1500 by 0.3. We add 850 by 0.4. We add 410 by 0.3. This will give us a figure of 913. Then the other one, we have a value of, believing that we are on the same page. The other item, we should be having 1.7 by 0.3. We add 905 by 0.4. We add 105 by 0.3. That is negative 105 by 0.3. So in that case, I'm having 840, 500. Making sure that you are getting the same values. So in this case, we want to take the expected value without perfect information. The expected value without perfect information will be the best EMV. And my best EMV here, I can see it is 913. So my expected value without perfect information, we are going to take 913,000. That is what we have determined. The next step here is for us to consider the expected value with perfect information. Expected value with perfect information. So, to determine our expected value with perfect information, my good students, you said, from our payoff table, we need to identify the best payoff under each state of nature. We need to identify the best payoff under each state of nature. So, under each state of nature, I'll come to what I'm given here. We check at high. What is our best at high? The best at high, the best payoff at high, I can see it is 1.7. The best payoff at medium, I can see it is 905. The best payoff at low, I can see it is 410. So we are taking the best payoff under each state of nature. So that is to say, at this point, high, I'd be having 1.7. Medium, I'll be having 905, and low, I'll be having 410. So on this, we multiply by the probability of each state. That one is 0.3, 0.4, and 0.3. So that as at the end of the day, what will be our expected payoff? I should be having 1.7 times 0.3. This should give us 510. 905 by 0.4. Of course, this should give us 362. Then I'm having our item of 410 times 0.3. This should give us 123,000. So what is the average? If we sum them up, I should be talking of 123 plus 362,000 plus 510. So I can see we're having what? Aspect of 995,000. So this will give us what? The expected value with perfect information. So it is upon us, yeah, to determine now our value of perfect information. So value of PI, we are going to take expected value with perfect information, which is 995,000, excuse me, less expected value without perfect information, which is 19,000. So we can agree that the value with perfect information, I should be talking of 995 minus 913,000, which will give us what? 82. So the value that this information will bring to my company, if at all we were to quantify it, it will give us 82,000. The value that this information will bring to our company, if at all we were to quantify it, it will give us 82,000. And how much was I spending to acquire, or how much can we spend to acquire this information? Look at what we are given. We are told that you are going to spend 100,000. A market research company believes it can provide perfect information at a cost of 100,000. So the cost of this information, the cost of acquiring this information. Cost of acquiring the information is 100,000. If at all it were you and you needed to advise this company, what will you go with? If the value that you're going to get from this information, if at all it was to be measured, you are going to get 82. But the cost that you can spend to acquire that is 100,000, and you need to advise. What do you think you're going to advise, of course, the company? Of course, in this case, it is not viable because the cost of acquiring that information is high compared to the value that this information is going to bring to the company. See, that is how you're supposed to always tend to work it out. At this point, you realize that once you have this concept right, all the questions for determine the value of perfect information will always tend to flow. So this was our first segment, of course, of this revision series. In that case, I want you guys to join us in our next class. Remember, you can also subscribe to our classes, which you can find them on our platform, app.mdarasa.co.ke, or better still, you can always reach us out for more guidance on advanced management accounting. You can always reach us out on 0708 068 851. Remember that advanced management accounting now for CPA, it is compulsory. And I know it is always very slippery without proper guide. So make sure that you reach us out and we'll be here to assist you guys. To that point, thank you so much and see you in our next session. Bye-bye.